Nigeria.
Good afternoon, distinguished ladies and gentlemen and members of the press. I welcome you to Central Bank of Nigeria. The Monetary Policy Committee met on January 19th and 20th, 2015 against the backdrop of challenging external conditions and downside risks in the domestic economic environment. In attendance were all the 11 members of the committee. The committee reviewed key external developments as well as domestic economic and financial conditions and outlook for 2015. The committee noted the tepid recovery of the global economy in 2014. The major impetus for global growth in 2014 came from the United States and supported later in the year by the drop in oil prices. However, both developments fell short of returning the global economy to the pre-crisis growth path. This was mainly due to the weakness in Europe and the much slower pace of expansion in the emerging market economies in particular. Specifically, global growth continues to be constrained by a number of old and new adversities, including high debt and rising unemployment in many countries, geopolitical tensions and conflicts, the negative impact of commodity price shocks on commodity exporting countries, weak external demand, and tapering and eventual exit of the U.S. Federal Reserve Bank from quantitative easing, triggering sharp corrections in the financial markets. Consequently, global output rose by about 3.3% in 2014, which was the same rate of growth attained in 2013. It is estimated to strengthen to about 3.5% in 2015. The committee, however, noted many downside risks to the outlook. The euro area and Japan appear trapped in low inflation and low growth conditions. High unemployment and debt could persist much longer in the euro area, in particular, while a possible deflation is likely if inflation continues on the downward trend. The committee also acknowledged the high likelihood of an increase in interest rates in the United States, which portends negative consequences for emerging and frontier economies, and already growth is moderating in most industrial countries and could further be dampened by the strengthening of the US dollar, more volatile capital flows, and financial system vulnerabilities arising from currency depreciations. All of these could be combined by increased risks arising from the militarism and of the Ebola epidemic in countries African. Furthermore, in the United States and the euro area policy stance, inclusive growth and bad impact of falling oil prices, with acute revenue shortages in countries like Nigeria, Venezuela, and Russia, add to the risk factors. Evidently, the outlook for growth in the various economic clusters continue to be shaped by the identified risks and opportunities. The IMF projects the major advanced economies to grow at a modest pace of about 2.3% in 2015, premised on the sustained growth in the United States and some improvements in Europe. The decision of the European Central Bank to continue with the existing provision of unlimited short-term liquidity, as well as the implementation of new programs, will be critical to the global economic performance in 2015. For the emerging markets and developing economies, growth could be modestly maintained in 2015 at about 4.3%, driven essentially by domestic consumption and increased investment as net exports continue to moderate in response to softening commodity prices. Inflation is not an immediate global priority as most of Europe and Japan grapples instead with potential deflation and high unemployment. The outlook for monetary policy suggests continued divergence among the various economic blocs. The euro area and Japan are expected to sustain this accommodative monetary policy stance, while the United States authorities appear to be leaning towards monetary tightening. Similarly, monetary policy is likely to remain restrictive amongst developing and emerging economies in order to stabilize their local currency and rein in potential inflation pressures. The committee was generally of the view that monetary policy play a pivotal role in restoring economic activity to optimum levels globally, especially when complemented by structural reforms, fiscal adjustments, and better coordination of policy actions. In fact, current conditions call for engagement of multiple macroeconomic and structural policy levers. Domestic economic and financial developments. The National Bureau of Statistics estimated real gross domestic product growth rate at 6.23% in the third quarter of 2014, compared with 6.54% in the second quarter. The committee noted the continued dominance of the non-oil sector, particularly services, which contributed 2.53% points, agriculture 1.25%, trade 1.08%. The committee noted with satisfaction the federal government's efforts to boost power generation and supply, among others, which will improve the economy's job creation prospects in the medium to long term. The committee was, however, concerned about the weakening contribution of the oil sector to overall growth, which is now being exacerbated by the rapid drop in oil prices since June 2014. In addition, the committee noted that the security challenges in some parts of the country might also be contributing to the dampening effects on overall growth in the country. Headline inflation at end of December 2014 was 8.0%, which was within the range of 6 to 9% benchmark for inflation set by the Central Bank of Nigeria. The inflation recorded in December 2014 reflects a reduction in core inflation, seasonal factors related to the Yuletide celebrations, as well as the stabilization in food prices. The committee, however, recognized some upside risks to inflation in the near term, including the likely higher import prices on the strength of an appreciating dollar and possible food supply bottlenecks linked to insurgency and insecurity in some major agricultural zones of Nigeria. Broad money supply grew by 7.29% at the end of December 2014 over the level in 2013. This represented a marked improvement over 1.32% increase in 2013, but lower than the benchmark of 15.02% for 2014. The relatively slower growth of total monetary liabilities reflected developments in both credit and the net foreign assets, NFA. During the period, credit to government contracted by 21.8%, far below the growth benchmark of 28.4%. Similarly, the net foreign assets declined by 15.02%. Credit to private sector, however, grew by about 12.1%, essentially pushing aggregate domestic credit growth of about 11%. The weak performance of net foreign assets was largely due to the lower oil prices, with the attendant consequences of reduced accretion to external reserves. The committee welcomed the posture of fiscal policy, which reflected the decline in credit to government, coming especially at a time when government revenue was greatly pressured by adverse oil price developments. The committee noted that this orientation of fiscal policy would have an overall beneficial effect by leaving deposit money banks with greater room to support the real sector of the Nigerian economy with the much needed credit. The committee encouraged the management of the bank to continue to implement measures aimed at providing support to enable increased flow of credit to the private sector. Interest rates in all segments of the money market trended upwards between 26th of November 2014 and the 13th of January of 2015. The interbank call rate opened at 8.98% on 26th of November 2014 and closed at 26.15% on 16th of January 2015. Similarly, the open buyback and 30-day NIBOR increased from 10.2 and 38 to 24.6 and 11.63% respectively during the period. The significant increase in these rates, particularly for interbank and open buyback, was mainly due to the further tightening measures introduced at the November meeting of the Monetary Policy Committee. The committee observed that the bearish conditions in the capital market continued as equities market indicators trended downwards in the review period. The all-share index declined by 16.1% from 41,329.19 to 34,657.15 between December 31, 2013 and the end of December of 2014. Similarly, market capitalization decreased by 0.2%, 18.23 naira to 11.48 trillion naira same period. Committee noted that the downward trend has continued into January 2015 as year to date both have declined by 16.2 and 15.7% respectively. Although this phenomenon is driven by global economic conditions, in Nigeria in particular, the situation is exacerbated by the declining oil prices as foreign portfolio investors divest from the country. These developments call for closer monitoring and proactive interventions by all institutions concerned. The committee reiterated its commitment to sustaining and deepening measures aimed at fostering confidence and stability in the Nigerian financial system. External sector developments. The committee noted that significant pressure persisted in the foreign exchange market during 2014, resulting in further weakening of the naira across the three segments of the market. The exchange rate at the retail Dutch auction and spot opened at 157 naira 34 kobo to the dollar, inclusive of the 1% commission, and closed at 164 naira and 8 kobo to the dollar, representing a depreciation of 12 naira 34 kobo or 4.28%. The interbank selling rate opened at 165 naira 70 kobo to the dollar and closed at 180 naira to the dollar, representing a depreciation of 14 naira 73 kobo or 8.63% in the period, while at the Bureau de Change segment, the selling rate opened at 170 naira to the dollar and closed at 191 naira 50 kobo to the dollar, representing a depreciation of 21 naira 50 kobo or 12.64%. Gross official external reserves as at December 31, 2014 stood at $34.25 billion compared with $42.85 billion at the corresponding period of 2014. of 2013, sorry. The decrease in the reserves level was driven largely by the increased funding of the foreign exchange market interventions to stabilize the exchange rate in the face of decline in reserve accretion. The country's external reserves, as at the end of December 2014, could finance 7.44, almost 8 months of imports, and which we consider very good given the average of 3 months that is the standard. The considerations. The committee noted with satisfaction the growth performance of the economy as well as the year-end inflation outcome. It was, however, concerned about a number of risks, including security challenge in parts of the country, which has continued to disrupt farming and related activities, and the sustained decline in oil gross domestic product. With regard to inflation, the committee noted the recurring challenge of excess liquidity in the banking system and the possible complications arising from capital flow reversals, as well as the demand pressure in the foreign exchange market. On the external front, falling oil prices, slowing global output recovery, divergent monetary policy postures between the US and the euro area, as well as non-inclusive growth, remain very important risks. The gradual normalization of monetary policy by the US Fed could exacerbate the current retrenchment of portfolio flows and increase pressure on currencies in emerging and developing countries, including Nigeria. In the light of the above considerations, the committee observed that its decisions of November 2014 needed some time for the effects to crystallize in the economy, and therefore voted to retain the current position. Consequently, the committee decided as follows. 1. All 11 members voted to retain the MPR at 13%, retain the CRR on private sector deposits at 20%, retain CRR on public sector deposits at 75%, and retain the liquidity ratio at 30%. 2. One member, however, voted for an asymmetric corridor around the MPR. I thank you all for listening. Good afternoon.
Yes.